You can look at a high-growth business and see healthy top-line revenue, but underneath that surface, a steady leak is quietly draining profit. Small, recurring process failures erode margins long before they trigger a formal audit or show up on a quarterly review. The symptoms of this leak are highly visible to anyone operating an Indian MSME. Late GST filings, blocked input tax credits, manually shuffling data between spreadsheets. The modern software market misdiagnoses these symptoms as a visibility problem. They assume that if founders just had better visibility into their deadlines, the friction would disappear. Because of this misdiagnosis, the default response from the tech sector is building more observation layers. They ship another reminder app, an aggressive notification engine, or a dashboard with colorful status indicators. But a dashboard cannot reconcile a ledger. A notification cannot route a tax payment. These tools are functionally useless for stopping the leak because they only observe the failure.
They do not alter the underlying system routing that causes it. Treating compliance as an administrative chore to be monitored ensures the bleeding never stops. The problem is structural. A serious monopoly-minded operator does not look at fragmented workflows and try to build a better alarm clock. They look at the architecture of the workflow itself. They look for the choke point. They want to find the exact layer in the stack where the final outcome is actually decided and controlled. For Indian MSMEs, that choke point is the dead space between their core systems. There is no default connection between their bank accounts, the GST network, and their accounting ledgers. Without a shared rail linking these nodes, the burden of compliance falls back on human memory. It relies on accountants manually handling exceptions and business owners remembering to execute routine tasks. Human memory does not scale. Manual exception handling breaks down entirely under the pressure and velocity of modern regulatory regimes. MSME compliance is an infrastructure orchestration problem. The only viable solution is a unified digital rail that sits beneath the software layer and enforces correctness by default. To understand why manual processes are mathematically destined to fail, we have to look at the raw volume of obligations placed on a typical Indian manufacturing MSME. This scatterplot maps the regulatory density for a standard manufacturing business. A single state operation has to navigate an average of 1,450 distinct regulatory obligations, maintain 48 different registers, and answer to 59 types of inspectors. When we chart the financial weight of this density, the result is a direct subtraction from the bottom line. Compliance costs alone create an annual drag of 13 to 17 lakh rupees per firm. The DPDP Act adds a new layer of complexity to this existing burden, introducing strict data handling requirements that impact every digital interaction. Crucially, there are no automatic exemptions for small and medium enterprises under DPDP. With penalties reaching up to 250 crore rupees for a breach, a single compliance failure now carries existential risk. Combine the existing GST friction with these new data obligations, and the math is clear. Any firm relying on fragmented tools and local accountants will eventually suffer a critical, expensive failure. The volume of data is simply too high. This regulatory density acts as a structural barrier. It shifts the primary focus of the business away from product output and turns daily operations into a game of administrative survival. If the system is this expensive and prone to failure, we have to ask a strategic question: who actually benefits from compliance remaining obscure and fragmented? This typographic layout illustrates the divide in the market. The first beneficiaries of the current mess are legacy accounting firms and compliance shops. They operate on an economic model built on hourly billing for navigating complexity. Fixing this system through automation directly threatens that legacy revenue model. If compliance becomes a default rail, the need for manual interpretation vanishes. The second beneficiaries are large corporate incumbents. A massive enterprise already possesses the capital required to absorb 17 lakh rupees in annual overhead without blinking. For these large corporates, excessive compliance acts as a protective moat. It financially suffocates agile new market entrants before they can gain a foothold. This creates severe incentive distortion among MSME founders. They are forced to manage risk instead of chasing growth. Capital that should be deployed into research, development, and product expansion is instead diverted just to feed the compliance machine and avoid penalties. The current fragmentation is not an accident. It is an economic structure that quietly protects incumbents while bleeding challengers dry. Escaping this incumbent trap requires abandoning the software-as-a-service mindset. You cannot fix a broken foundation by selling a subscription to a better interface. You have to adopt an infrastructure mindset. We have seen this work before with digital public infrastructure. By building shared foundational rails like UPI, the Indian market successfully orchestrated complex financial routing at scale. This systems diagram maps the problem for MSMEs. Currently, we have 4 isolated nodes: bank, GSTN, ledger, and DPDP. A compliance DPI requires a shared orchestration layer that sits strictly between the business and these regulators. When an orchestration rail connects these isolated nodes, it enforces correctness at the transaction level. Data is verified and reconciled before it is ever submitted. This system also bakes in DPDP-aligned data handling defaults at the root level. It filters out non-compliant data routing instantly. completely removing the decision-making burden from the user. The operational shift here is absolute. Compliance stops being an end-of-month panic involving 10 different spreadsheets and becomes an invisible byproduct of daily business routing. A unified digital rail neutralizes the incumbent moat. It makes regulatory adherence automatic, cheap, and default. Solving fragmentation requires a unified orchestration module to physically snap these disconnected business inputs into one continuous path. The strategic value of building this rail lies far beyond the 17 lakh rupees in annual operational savings. The firm that successfully orchestrates this flow moves from being a workflow vendor to the primary source of risk assessment. Because this rail sits between the bank and the regulator, it captures a live, unalterable picture of a company's operational discipline. It sees exactly what gets filed on time, where process fails, and where cash flow breaks. Contrast this pure system data with traditional financial dashboards. A dashboard relies on self-reported inputs, which can be manipulated, delayed, or selectively edited by the user. Whoever controls the default compliance routing automatically captures the cleanest, most honest data regarding a business's actual operational health. That level of visibility creates a mechanism we can call underwriting truth. An aligned system instantly transforms a messy, fragmented operational record into a perfectly legible, highly reliable trust signal. Underwriting truth makes it viable to distribute credit to millions of previously unscorable MSMEs with exact precision. This data stream enables embedded finance, dictates enterprise supplier selection, and establishes significant pricing power. Early recognizers who build for infrastructure rather than visibility create a monopoly control point, locking in growth that compounds as the system scales. Many of the most important technological breakthroughs do not rely on loud hype or flashy interfaces. They rely on quietly restoring system order where chaos used to be. The next major billion-dollar business in the MSME sector will not sell AI productivity tools. It will be the quiet rail that makes business trust machine-readable.